Hello, everyone. Welcome to today's session. We're going to be covering FAQ 4862, 4864. Um, so, today's session is going to be a quick one as well. We won't be covering a question again. Just going to be a high level overview, and then I want to give you a summary on how to set out financial statements from a group perspective so that when we start doing questions from next week, you have an idea of how to set out financial statements, what makes up financial statements, and you can just focus on the complexity of groups. Okay. So other guys, there's a few that won't be joining tonight. Some can't make it on a Wednesday, and some having load shedding and other commitments. But they will watch the recording, so therefore we will continue. Um, Before we go on, how are you guys finding? Um, do you guys get time to study, like on your own? Did you manage to work through some of the material, whether it's through this course or whether it is just through your niece's material? Um, can you share with me? Ratu, will go with you first. I don't know if she's there. Fakir.
Okay. What were you asking?
I was asking, did you manage to start studying already? How are you finding it? I, I know it's only week one or week two, but I know some of you guys have been studying already before the Edions course have started. Um, so have you? And if you did, how are you finding it so far? And I'm not talking about this course, I'm talking about just your studies in general. So how's it going?
Oh, okay. So I started. I might have started a week later than what the tax and things were saying. But
Okay.
then again, the whole timetable of Eunice's pretty messed up at the moment. So I did start studying. Um, I got a different approach to third year stuff this year, CTA. So it's been working for me. I don't sit like with one module for hours. I sit for like 1.5 to 2. And when I leave there, I need to understand something at least. So if I do that, then I can fit about 3 modules in the evening. It's tiring sometimes, and but these classes also help.
So
But yes,
I'll quickly. So you're saying 3 modules in one evening.
yeah. So when I'm done here with this class with you, and I usually sit with 2 other friends of mine, and then we go through another topic. And then when I finish off there, I take a 30-minute break or whatever the case may be. And then I just jump into something else, but not like the entire chapter because it's too much. And then you just
Uh,
start reading but not taking in. So yeah.
okay, not bad. And how do you find CTA so far? I know it's only the beginning. You're gonna have one perspective now. After test one, you'll have a different perspective. So before test one and currently, how are you feeling about CTA?
Look for me, the way I'm going to be able to know where I'm standing is after this one. But at the moment, the content and the thing, it's more content. It's a little bit more technical, but it's also not that bad for me because I work in internal audit at Sanlam. So it's easy to put your mind in that space and then just try to apply the things that you're reading here. But generally, it doesn't matter where you work. All you do is just put your mind in the space as if it's you actually doing it, and that's been
Mm,
working.
nice. Okay, shukran for your input. Ashita, you want to share something? How are you finding it so far? No, Ashita, you don't want to share? I don't see Lerato. Okay, I guess not. Um, Okay, so let's go into today's session. So we're going to cover um, groups, an overview of groups. So I know most of you have been on the consolidation class, so I'll just go a high level theory on that. Um, and then I will upload the consolidation class as well once I do the uploading with load shedding and so forth. It's been a bit of a mission to actually upload because I have to upload it. So to actually put it together, it's quite quick, but to upload from the platform to YouTube literally takes 4 or 5 hours. So with load shedding, it shuts down and then all of those type of things. So once I upload it, I'll also upload it onto the actual platform so that you guys can view it. So I'm going to do a quick overview. Then I want to show you how financial statements are set up. And that is very, very important. So that when you look at this, when you read a scenario, and when you see a required, and the required say, prepare a statement of financial position, prepare the statement of profit or loss and other comprehensive income, prepare the statement of changes in equity, without knowing the details of the topic, without knowing the details of the scenario, without knowing the exact numbers, you must already know what how the financial position will look, what is included in the numbers. Same for the income statement, same for the balance, same for the statement of changes in equity. Because if you already know what numbers needs to be included, it's going to be easy for you to find it because you're going to go look for specific numbers. So I just want to get to today. I just want a quick recap on group accounting. Remember, the whole purpose of group accounting is to prepare one set of financial statements to present all the companies in the group as if they are one economic entity. That's the whole purpose, to present one set of financial statements for all the companies within the group in such a manner that they represent one economic entity. And because they represent one economic entity, you only want to reflect transactions of those outside of the group, meaning transactions with third parties. So any transactions between companies within the group needs to be eliminated. Why? Because all the companies within the group is now one economic entity, so you can't transact with yourself. From a separate or an individual financial statements point of view, those transactions between the group companies, those are valid. But from a group perspective, we need to eliminate them. So just keep that in mind. Why does it make sense to prepare group financial statements? Remember, if you go back to the conceptual framework, the objective of financial reporting, the objective of financial reporting is to provide users with financial information that is useful for decision making. Now, who are our users? Our users are, the main users are our primary users. And our primary users are your current and potential shareholders, your current and potential lenders and creditors. Now, if you are a shareholder, if you want to invest in the share of ShopRite, you are not only investing in ShopRite, you are not only investing in Checkers, you're investing in ShopRite, Checkers, and whoever else. Why is that the case? Because the only share you can buy on the JSE relating to ShopRite is the ShopRite Group Limited. There's not Checkers on the JSE, there's not ShopRite on its own on the JSE. It is the ShopRite Group. And who is the ShopRite Group? All of those other entities together. Similarly, with Foschini, if you want to buy a share in Foschini, you can't buy Foschini only. You can't buy Markham's only. You can't buy Total Sports only. Because the only share traded on the JSE relating to Foschini is the Foschini Group. And who is the Foschini Group? It is all those other entities, Stearns, Foschini, Markham's, Total Sports, Sports Scene. I mean, there's so many others as well. So just keep that in mind. And because there's only that one share, that one company shares that you can buy, You need financial information to help you make a decision whether you should invest, whether you should withhold, keep your investment, or whether you should exit the investment, and so forth. So just keep that in mind while we prepare group financial statements. Another reason to just, which is a little bit slightly different to be, if you look outside of the objective of financial reporting, the question is, why do we even bother with group financial statements? What's important, the not the current. When I was a student at UCP, the college, the head of the College of Accounting. So the head of the College of Accounting, his view was always that we shouldn't um, we shouldn't be doing group accounting in CTA or in the CA qualification. That is his view, and he told us that his view is that his view is that he doesn't believe in still doing group accounting. However, every single year he gets closer to buying into Syker's argument. So I'll explain what he was saying. So he said, he was a finance director and all of those type of stuff, and he said not many people deal with group accounting. And remember, Syker's objective is that they just want to prepare a CA to be an entry-level CA to do general accounting. Anything specific, you must learn that as you evolve as a CA. That is why they remove earnings per share from the syllabus, because earnings per share is not really a general thing that everyone uses. It's only listed companies. And that is why they, similarly with in PPE, they removed revaluation on depreciable assets. Why? Because in the real world, many companies don't use revaluation on depreciable assets, even though it is within the accounting standards. So cycle objective is to provide you with the necessary knowledge and skills and competence so that you able to enter the world as a newly qualified chartered accountant with the necessary skills and competence. And then as you evolve in the industry, as you evolve in your career as a CA, if you enter financial services, you're going to have to learn specific things relating to financial services. If you enter petroleum and oil and all of those type of stuff, you have to learn those specific things, but you don't deal with it. So for example, when I joined Old Mutual and at Signia, um, I entered the financial services, and one of my responsibilities was to calculate income tax for a life insurer. Now, we don't learn income tax for life insurance in not for life, for long-term insurance, income tax for a long-term insurance. We don't have we don't learn that in CTA or in our studies. Why? Because it is a specialized standard. If you pick up the textbook of income tax and you look for insurance, there's a section there, and when you go to that section, it says we don't cover this in this book because it's a specialized area. It's beyond the scope of this textbook. But as an accountant, I still needed to learn it. So I had to go study the tax act to actually apply. So that's what this psych is trying to achieve, right? So understand that. So this FD is used. So this that times head of that times UCT's head of College of Accounting. He's using that same thinking, and he's saying, why are we dealing with group accounting? Because not everyone gets to do group accounting. It's really only in certain, if you are a group in the group team or something of that nature. This is what Syker's argument is. Syker's argument is as follows. They said, similar to high school, when you're learning maths and science, as a CA or as an accountant or even just a general person, there's many concepts within maths or even science that you don't really use. Trigonometry, for example. How many of us use trigonometry? But why is it still in the syllabus? It is because it helps you with a way of thinking. It helps you with problem solving. It helps you with critical thinking. Now, the same thing with group accounting. Although it's not something that you're going to encounter every day, even as an auditor, only the audit team that is looking after the group Fs, if you even dealing with a group company, will deal with consolidations. But consolidations helps a CA to develop a certain way of thinking that is critical for a CA. And that is the main reason why group accounting is in the syllabus. If it wasn't for that reasoning, group accounting may have well been removed from the syllabus. So just be aware of that. Um, why I'm mentioning this, because we're going to follow an approach that is not necessarily straightforward, right? When I say not necessarily straightforward, I mean you're not going to get it like that. But once you do get it, your way of thinking will be so much different and you'll be able to handle any group question, whether it's in an exam or whether it's in the real world, because you're going to have a way of thinking. Now, if you don't, if you're gonna follow the approach that most students follow, so I don't know if you remember being in third year when you did Factory 704. I have tutored countless students for Factory 704, and probably 98% of the students I've tutored for Factory 704 merely memorize the transactions, because you just have to do probably 5 to 6 past papers and you can get 100% if you studied it properly. But ask them to explain it, they can't. Now, I hope if you are one of those, or hopefully you weren't, but I want to show you a different way so you don't have to memorize and but it's not necessarily going to be easy immediately, and you may get irritated with me in terms of repeating the same thing over and over in terms of the thinking approach, but ultimately it's going to help you really, really much. So just be cognizant of that, and that is why I was telling you the story as to one of the reasons why group accounting is still within the CA syllabus. It is not because that it's so really important in terms of you're going to encounter it every single day, but in terms of the learning, the critical thinking, the way of thinking, the problem solving, that is what group accounting is. That's the main one of the main reasons that Psyche has, whether they tell you or don't tell you, um, is the purpose for group accounting in the CA syllabus. So please, um, when you study group accounting, remember that, so that you push hard to actually understand what you are doing and why we are doing what we are doing, so that you can actually, so that your way of thinking and you develop what is required of you. Okay. So remember, we spoke about now the objective. We spoke about what was the other thing we spoke about? Um, what is group accounting? Okay, so just be aware of that. Remember, group accounting, you need to identify the nature of the investment and the type of influence. So remember, the type of influence is either a subsidiary, um, the type of influence is either control or joint control, or significant influence or no influence. If you have control, you have a subsidiary. If you have a subsidiary, you have to consolidate. If you have joint control, then you have a joint arrangement. A joint arrangement is either a joint operation or a joint venture. If it is a joint operation, then you will do partial consolidation. If it is a joint venture, then you will do equity accounting. And if you have significant influence, you have an associate. And for an associate, the accounting treatment is equity accounting. If you have no influence, it means you just have a normal investment. And for a normal investment, you apply fair value accounting, and fair value accounting is applied in terms of IFRS, and then fair value in terms of IFRS 9. So just be aware of that. Okay. For Fact 2, most of the course is groups, and we will apply the way of thinking continuously throughout the semester, throughout the year. And when we come to consolidation, we're going to teach you and we're going to go through what is consolidation and how to apply consolidation. When we get to And then when we get to associates, we can apply equity accounting and how to apply equity accounting and all of those type of stuff. So I'm not going to cover that now. That we'll cover within a question. So that is a high level of group accounting. Now, remember the thinking approach when it comes to preparing consolidated financial statements is as follows. The end point that you're trying to achieve is your group annual financial statements. So your end point is your group annual financial statements. Now, in accounting in general, and specifically in group accounting, without doing any calculations, you must already know what to expect. Even if you don't know the exact number, but you need to know what you want at the end point. So, in the same way, when you're going from A to B, you need to know where is B. You need to know what B is. You need to know your destination. So same thing over here. The destination in group accounting is your group annual financial statements. So you need to know what is the destination. You need to know what is the group annual financial statements. So what is the group annual financial statements? It is basically the end point which needs to be 100% of the parent's assets, liabilities, income, and expenses on a line by line basis. When I use the word line by line, we're meaning revenue, cost of sales, other income, other expenses, PPE, investment property, intangible assets, inventory, debtors, cash. That is a line by line basis. A line by line basis just means whatever you see on the income statement and the balance sheet as a line, that needs to be in the group annual financial statements. So for the parent, it is 100% everything of the parent's assets, liabilities, income, and expenditure on a line by line basis, but not anything of the parent. It must be from the parent stuff from a group perspective. So what's the difference between the parent on a group perspective and the parent's individual numbers? Remember, the parent's individual numbers may have intercompany transactions. Now, from a group perspective, we don't want that. We only want items that is from a group perspective. Okay? Then as part of your group annual financial statements, you want your subsidiary. The subsidiary needs to be 100% of the subsidiary assets, liabilities, income, and expenditure on a line by line basis. Once again, the 100% of the subsidiary needs to be from a group perspective. So, what's the difference between the end point of a subsidiary and the starting point of a subsidiary? The starting point of the subsidiary is the subsidiary's individual trial balance or separate trial balance. Included in that individual or separate trial balance may be intercompany transactions, may be amounts that was not recognized at fair value, and hence there will need to be some adjustments that need to be made. Continuing from there, I'm going to stop at this one because we will do the rest when we in for test two when we deal with joint arrangements. The next one is associates, significant influence. The end point, the group annual financial statements of the associate only once the parent's portion of the associate, but not on a line by line basis. So the income statement only wants the parent's portion of the associate's profits, the parent's portion of the associate's other comprehensive income. From a balance sheet point of view, the parent don't want assets and liabilities on a line by line basis. They only want their investment in the associate. So you just need to be aware of that. You need to know when you have an associate in your question, you must already tell yourself, okay, I have an associate. So in my consolidated profit and loss income statement, I expect to see share of associates profits, share of associates OCI. In the balance sheet, I expect to see investment in associate. So just be aware of that. And then when you have a subsidiary, you need to tell yourself in the income statement, I expect to see on a line by line basis included in revenue must be the parent's revenue and the subsidiary's revenue. In in cost of sales must be the parent's cost of sales and the subsidiary's cost of sales. Similarly, on the balance sheet, when I see PPE, PPE needs to be PPE of the parent and PPE of the subsidiary. Debtors needs to be debtors of the parent, debtors of the subsidiary. So that is the level of thinking you want to get to. So what is your endpoint? You need to know what your endpoint is. You need to know what your end point is, which is the group annual financial statements. What is the group annual financial statements? That is what I just basically explained. Your starting point is simply the trial balance of the separate and individual companies. So the parents' separate trial balance, it is going to be the subsidiaries' separate trial balance. Your starting point only have the trial balance of the parent and the subsidiary. It does not have the trial balance of the associate or joint venture. So please be aware of that. Your starting point for group accounting is only 100% of the parents' separate trial balance and 100% of the subsidiaries' individual trial balance, nothing of the associate. So just be cognizant of that. I will explain that again when we do some questions. Like I said, I'm going to repeat this over and over until it clicks. Okay. So that is basically a high level understanding of group accounting. We will get into the more nitty-gritty details and the intercompany transactions when we do a question. What I want to do now in the next 30 to 40 minutes is show you how financial statements will look for a group, for a consolidated set of financial statements. So I'm just going to share Excel. Tell me once you can see. You should be able to see now.
Yeah, can see.
Okay, so here we're going to go. So here we will cover this now. Um, so remember, every set of financial statements have three parts. It have the name, the company name, the statement name, and the date. So you will have company name. If you're doing a consolidated financial statements, you need to put the word consolidated. So we're going to say consolidated. Statement of profit or loss and other comprehensive income. Okay, so that's the name. Comprehensive income. Income, and then you have the date. I just put the date over here for the year ended. You will put in one line. I'm just putting it over here for the year ended, whatever. Okay. So now we're going to have what makes up the statement. So remember, you're going to have revenue. You're going to have cost of sales. And then you're going to have gross profit. Okay. And then you will have other income. You will have other expenses. This is a typical way that your niece's income statement look. It won't, remember, every company's income statement is not the same. So maybe the way your niece does it may be different to the way Stellenbosch different to UWC, different to UCT, different to WITS, different to UJ, different to KZN, could be different, but ultimately, this is how an income statement looks. I'm doing it the way UNISA usually does it. So you have revenue, cost of sales, gross profit. Then you have other income, other expenses. Then you have profit before tax. Then you have income tax. And then you have profit after tax or profit for the year. Okay, profit after tax or profit for the year. Then we will have other comprehensive income, other comprehensive income. So typical examples of other comprehensive income. I'm not going to necessarily follow the technical approach of how a comprehensive income look. I'm just going to name the stuff. So you could have revaluation, gain or loss. You could have marked to market, and then you'll have total comprehensive income. Okay, total comprehensive income. Total comprehensive income. Once you have total comprehensive income, because you're doing with a consolidated statement of profit or loss and other comprehensive income, you need to split profit between parent and subsidiary, parent and NCI, and you have to split these total comprehensive income between parent and NCI. So we will say profit attributable to, what I don't know how to spell it, to, we have parent, and then you have NCI. And then you have over here, we'll have total comprehensive income. So please be cognizant of that. Total comprehensive, not OCI, it is TCI. Total comprehensive income attributable to parent NCI. Okay, so just be aware of that. Okay, so that is how it will look. Now, what makes up all of these numbers? Okay, remember for revenue, 100%, 100% of parent plus 100% of subsidiary plus group adjustments. Why we say group adjustments? Let me explain. Remember, we're trying to achieve the end point. We're trying to achieve the destination. What is the destination? It is the group annual financial statements. What is the group annual financial statements? It is 100% of the parent on a line-by-line basis from a group perspective. It is 100% of the subsidiary on a line-by-line basis from a group perspective. Our starting point is 100% of the parent, 100% of the subsidiary based on their individual and separate trial balances. Now, these trial balances may include intercompany transactions. Now, we need to get that starting point to the end point, which is still 100%, but now not based on an individual or separate trial balance basis, but based on a group perspective. So the only difference between what the group wants and what the starting point is basically your group adjustments, and that are twofold. Number one, intercompany transactions and any fair value adjustments at acquisition. So if there was fair value adjustments at acquisition relating to a subsidiary, then that will form part of your group adjustments. Why? Because what the subsidiary has in its individual trial balance is different from what the group wants. Because remember, a fair value adjustment means the carrying amount in the trial balance is different to the fair value, and the group's cost is the fair value, whereas the subsidiary's cost is based on original cost. So then there will be differences. So keep in mind, your end point, your destination is the group annual financial statements. Your group annual financial statements is 100% of the parent assets, liabilities, income, and expenditure on a line by line basis, but from a group perspective, plus 100% of the subsidiary assets, liabilities, income, and expenditure on a line by line basis, but from a group perspective. So, to get the starting point to the end point, we use a mechanism known as pro forma journal entries. Pro forma journal entries represents the group adjustments. The group adjustments are twofold: intercompany transactions and any adjustments relating any group adjustments relating to fair value adjustments at acquisition. So just be aware of that. Okay. So all I can do is copy this over. So on a line by line basis, we have parent and subsidiary from a group perspective. Other income as well. I don't do about gross profit because gross profit is basically sales minus cost of sales. Then other expenses. Okay. And then same thing for income tax. It is on a line by line basis. There's one thing we need to still add in over here. So you can see where the question includes it. I'm just going to put it here for now. You have to look on the scenario where they put this line item. So here you will have share of associates profits. Similarly, over here, we will also have share of associates, but now you can't call it profits, you call it other comprehensive income. So what's the difference? Our starting point does not include the associate. We don't include the associate's trial balance in our starting point. Our starting point only have the trial balance of the subsidiary and the parent. It does not have, so in the starting point, there is zero of the associate. But what does our end point want? Our end point for an associate, we have to use equity accounting. Equity accounting says our end point in the income statement want our share of the associate's income, profit and loss. And from a balance sheet perspective, equity accounting stipulates that the balance sheet needs to have an amount representing the investment in associate. So from the income statement point of view, our starting point is zero, and our endpoint wants our share meaning the parent's share or the group's share of the associate's profits. So therefore, all we're going to do is have a calculation and then a journal entry to bring in our percentage of the associate. Okay, so our percentage of the associate. We do not bring our percentage of the associate's revenue, cost of sales, other income, other expenses. We don't bring it on a line by line basis. We simply bring our percentage in one line called share of associates profits. And then because the profit and loss, the income statement have two parts, profit or loss, other comprehensive income, we have a separate line item showing our share of the associates, other comprehensive income. Very, very important. They may give you a scenario where the income statement is already prepared and they ask you critically evaluate the income statement. What they will most likely do, they will bring in your share of the associates' profits, but on a line by line basis. So in revenue, you will see 100% of parent, 100% of subsidiary, plus your percentage of the associate. You must automatically pick up, oh, that's a problem, because for an associate, we don't bring our percentage on a line by line basis, but rather we bring the net profit number in one line called share of associates profits. Please be aware of that. Similarly, over here, we're going to bring in our share of the associates other comprehensive income for the parents, and we'll bring in 100%. So please be aware of that. That is very, very important. Now, I just use the word associate. If they give you a joint venture, the way you treat an associate is exactly the same as you treat a joint venture. So when we do a question, whether it's a joint venture or an associate, You must know it is the same thing. Um, in terms of accounting treatment. The actual venture may be different. One is a joint venture, one is an associate, it's a bit different. But from an accounting treatment point of view, it's exactly the same. So if the question have a joint venture, the only difference is you will call this share of joint ventures profit and not associates profit. Similarly, over here, you will call that share of joint ventures other comprehensive income. Other comprehensive income. Okay, so we're happy with that. I just need you to see this without numbers. You must already know, okay, that my starting point is 100% of the parent, 100% of the subsidiary. They're separate individual trial balances. My endpoint is 100% of the parent, 100% of the subsidiary on a line by line basis, but from a group perspective. The way I'm going to move from a separate and an individual trial balance to a group perspective is through group adjustments. Group adjustments is achieved by processing pro forma journal entries. Our group adjustments are made up of two things: any intercompany transactions and any fair value adjustments relating to a subsidiary at acquisition. So just be aware of that. So if there's any intercompany revenue, then you know that there's going to be a group adjustment relating to revenue. If there's any unrealized profits relating to inventory, then you must know cost of sales will be impacted. If there is any dividends declared from a subsidiary, automatically the parent would get. Then sitting in other income of the parent is dividends received from their investments. So we need to eliminate that. If there was any intercompany, if there was any intercompany sale of a depreciable asset, then we must know, and there was a profit made. Sitting in other income is a profit on the sale. We need to eliminate that. And in other expenses, depreciation needs to be impacted. So as we go through the year, but especially for test one, um, I'm going to make sure, and I'm going to hope you're going to get to that point, that you are able to talk to me about an income statement and a balance sheet, like I'm talking to you over here, without a scenario. You must be able to tell me how you're going to adjust revenue given certain transactions. How are you going to adjust cost of sales? So without numbers, that is the level I want to get you to. So that when you go write your test one, you already know when you go lay in bed on the Monday evening before you write before the Tuesday, you must already run this through your mind. You must already know the types of journal entries, types of intercompany transactions, and how to process the journal entries and how that will impact how the balance sheet and the income statement looks. So just be aware of that. This is how it is. I'm not going to go through the split over here that you have to do in a more detailed calculation. So I won't do that now, but that is how the income statement would look like. Before I move on to the balance sheet, do you have any questions? Fakir, Lerato, Ashita, any questions?
No questions from my side.
Okay, so I'm assuming no questions. Okay, let me just see. Okay, so now we will have, now we're going to do the balance sheet. So here we're going to have, once again, company name. So I'm just going to copy this over. It's company name. So we're going to have company name, and then we're going to have the statement name. Because doing groups, you will always have the word groups. So there we're going to have statement of financial position. Statement of financial position. Okay. Remember, all the statements is for the year ended or for the period ended. Why I say period, remember you can have 6 months, whatever, 4 months. So that's why we say period. But generally for our purposes, it's a year. So we say for the year. It is only the balance sheet. It is only statement of financial position that we call as, that we say as at. Why? The income statement represents income and expenses for an entire period, so for an entire year, whereas the balance sheet represents amounts at a point in time. So if we 31 December, then that means the balance sheet represents assets and liabilities at 31 December. So therefore we say as at. Okay. So now let's do the balance sheet. So we'd have assets. The balance sheet is, remember, if you look at the balance sheet, it's effectively the accounting equation. It is assets equal equity plus liabilities. So we have assets, we'll end up with total assets. Then we will have equity and liabilities. You will end up with total equity, total equity and liabilities. Okay, so that is what we're going to have. Then under assets, remember based on IAS 1, assets is split between non-current assets and current assets. Okay, liabilities is also split between non-current liabilities, non-current liabilities and current liabilities, current liabilities. Okay. Okay, so just be aware of that. Then under equity, under group, you're going to have the parents portion and then the NCI. So equity will look like this. So now make some more space. No, not there. Equity will look as follows. I'm going to give you the typical ones, and this is the typical ones, excluding anything relating to change in ownerships. Okay, so under equity, we will have share capital. You can have preference shares. I'm just going to ignore preference shares for now. We're going to have retained income. Retained income represents all income that is left over for all the years after a dividend has been paid. Okay, so retained income represents all the leftover profit or loss over the entire, represents all the accumulated profits over years after a dividend has been declared or paid. So that is retained income. Then you can have revaluation. Revaluation surplus. This typically represents any revaluation on PPE. Okay, you generally separate the various OCI revaluations. So the typical OCI revaluation that we have is a revaluation on PPE. Any revaluation gain or loss on PPE goes through OCI. The second common one that we have is a revaluation with fair value gain or loss on financial instruments that goes through OCI. So remember, under financial instruments, you have amortized cost and you have fair value. Then fair value is either fair value through profit or loss or fair value through OCI. So here is fair value through OCI. So UNISA usually calls a fair value through OCI marked to market. Okay. So I know this is also one of those areas that many, I think, like if I can put it, if I can be bold and say 100% of students I have tutored in Fact 3704 that found this very confusing. What you must know, mark to market reserve. So why I find this strange is because the same student that struggles with mark to market reserve can deal 100% correctly with revaluation. So what I want to tell you, that mark to market reserve is exactly the same as revaluation. So many of us knows a revaluation gain on land. Okay. So in the same way, you have a revaluation gain on land, you can have a revaluation gain on shares. So mark to market reserve is simply a fair value gain on shares that you hold, and that you have chosen to take that fair value through OCI. We just call it mark to market reserve. But remember, it is simply a revaluation gain on financial instruments. The way you treat a revaluation gain on land is the exact same way how you treat a revaluation on financial instruments. The only difference over here, when we have a revaluation on land, we call it revaluation surplus. When we have a fair value gain that goes through OCI on financial instruments, here we call it mark to market reserve. Okay, so just be aware of that. Um, so that is the typical ones we will get. I'm not going to go through. Um, I'm not going to go through stuff that will come through in change in ownership. So that's all for now. Then you will have parents total. Once you have parents total, then you will have NCI, non-controlling interest, and then you will have total equity. Now, it is best to do these calculations using the statement of change in equity. What I tell my students, if it's not straightforward, if this calculation is not straightforward, even if you are not required to prepare a statement of changes in equity, use the statement of changes in equity as a calculation, okay? Because then the chance of you getting it right is much higher. So when there's a complex calculation for the balance sheet relating to total equity, then I use the statement of changes in equity as a calculation format, because then you will get the right numbers, okay, assuming you get the equity statement right. So that is that. Now we can go to non-current liabilities. Your typical non-current liabilities will be a long-term loan. And then if a deferred tax is a liability, remember a deferred tax is always non-current. How do we know that? The accounting standard says deferred tax is a non-current asset or liability. So if deferred tax is a liability, it will be under non-current. That's your typical non-current liabilities. Your typical current liabilities is trade and other payables. Okay, that's it. Then now we come to total assets. Under total assets, you have non-current assets. Your most common one is going to be PPE. You may have intangible assets. You may have intangible assets. I think all of you here is that's on the class now is CTA 2 students. But for those who are going to watch it later on, if you're in CTA 1, this one investment property is only applicable to CTA 2. Okay, you cover investment property in CTA 2 only. So then you will have investment property. So you have PPE, intangibles, investment property. Then if you have a normal investment, if you have a normal investment, you can have an investment over here. We'll just call it investment. Okay, so or investments. So when you have a normal investment, meaning as an investment that has no influence, we simply call it investments. It will investments could either be current or non-current, and in most cases, it is split between current and non-current. So as I'm putting it over here. Now, when it comes from a group perspective, now when we have from a group perspective, there's two more things. Do not forget, when you have a subsidiary, you will most likely have goodwill. Okay? When you have a subsidiary, you will most likely have goodwill. And if you have an associate or a joint venture, you will have investment. You'll have investment in associate. Investment in associate is also non-current, because generally you have significant influence for the long term. You're not going to just have it for a short term period. Okay, so it will generally be that. So those are the typical, there could be more, but these are the typical line items under assets, okay, and under non-current assets. So when you read a scenario, when you see a subsidiary, what must trigger that I must not forget that I will have goodwill? Because remember, Goodwill only arises through consolidation. And hence, when you bring on 100% of the subsidiary, the starting point won't have goodwill because the individual trial balance does not have goodwill because it's not a group company. Only when you're preparing consolidated financial statements will you have goodwill, and hence you'll have to bring goodwill on through a pro forma journal entry. Similarly, investment in associate, you won't see it in your starting point. The trial balance won't have investment in associate because um, your starting point of an associate is zero, and more importantly, investment in associate only comes to life through equity accounting, and you only apply equity accounting in a group scenario. So therefore, so you must not forget about an investment in associate, and do not forget about goodwill. That only arises through group accounting. Therefore, those two numbers will come through pro forma journal entries. Then we will have, okay, and then just one more thing, like I had under non-current liabilities, if the deferred tax is an asset, then you will have deferred tax, deferred tax asset. If deferred tax is an asset, then it will be under non-current assets. Then under current assets, the typical thing would be inventory. It will be trade and other receivables, and it would be cash and cash equivalents. These are typical items. So once again, when we come over here, investment PPE will be 100% of the parent, 100% of the subsidiary plus group adjustments. Remember, there will be group adjustments if there was an intercompany sale of PPE or there was a fair value adjustment at acquisition relating to PPE. There could be intangible assets, there could be investment property. Remember, for a CTA2 student, for investment property, what could happen from a group perspective, from the separate and individual trial balance, from a non-group perspective, the parent could be leasing a property to the subsidiary or vice versa. So in the separate books, the parent or the subsidiary will have an investment property. But from a group perspective, we that is now owner occupied because the parent is leasing to the subsidiary. The subsidiary is thus using the property. So from a group perspective, the parent and the subsidiary is one. So we are owner occupying the property. So automatically that property is no longer investment property from a group perspective, but PPE. So that will result in a group adjustment. So just be cognizant of that. If you have normal investments, meaning there's no influence, it's not a subsidiary, I mean, there's no control, there's no joint control, there's no significant influence, that means you have no influence, a normal investment. You will bring 100% of the subsidiaries' normal investments, 100% of the parents' normal investments. If there are group adjustments, highly unlikely. Just be aware, not every single line item will have a group adjustment. Some line items you take simply 100% parent, 100% subsidiary, and then it's done. But your typical adjustments will be under PPE. Your typical adjustments from a CTA point of view could be investment property. You will hardly have adjustments under investments, but they could be. And then for goodwill, remember goodwill you bring on based on that goodwill calculation. So it's not 100% of parent to 100% of subsidiary. There's zero in the starting point. It will come through the pro forma journal entry. Typically, it comes through your at acquisition journal entry. So just be aware of that. Similarly, with investment property, with investment in associate, there's nothing in the starting point. Investment in associate relates to the associate. So we'll do a calculation. I'll show you how to do a calculation in next week's lesson, the following week's Zoom class when we do investment in associates, how you calculate investment in associates. For deferred tax, 100% of parent, 100% of subsidiary, any group adjustments. There will most likely be group adjustments for deferred tax because if there is a group adjustment relating to PPE, inventory, and so forth, then there will most likely be a tax consequence. The tax consequence goes to deferred tax. Similarly, for inventory, 100% of the parent's inventory, 100% of the subsidiary's inventory. However, the starting point, which is the parent's separate financial statements, the starting point, which is the subsidiary's individual financial statements or trial balance, may include intercompany transactions. And as a result, from a group perspective, we need to eliminate intercompany transactions. So we have to process group adjustments. Then trade receivables, same thing. Cash and cash equivalents, same thing. You will hardly ever have, you won't have adjustments to cash from a consolidation point of view because remember, pro forma journal entries is just basically, if I can call it in inverted commas, fictitious, unreal. Pro forma means basically not real. Now, cash is real. The cash is either there or it's not there. You can't process a journal to make cash. Okay, the cash is either there or it's not there. So therefore, there won't be group adjustments to a cash and cash equivalent balance. Okay, under share capital, remember when it comes to NCI only arise through a subsidiary, and it only arise through a subsidiary when you have less than 100%. So why do we have NCI? As you can see in the income statement as well as the balance sheet, for the parent and the subsidiary, we're bringing on 100% of the assets, liabilities, income, and expenditure on a line by line basis. Whether we have 100% of the subsidiary or not, we still bring on 100%. So when it comes to the equity, we now say, okay, our profit and loss have 100%, our assets and liabilities have 100%, but 100% does not exactly belong to us. So in the equity statement or the equity section, we there split. We say what belongs to us and what belongs to NCI. Like I said, work through the equity part of the balance sheet by using the statement of changes in equity. And here under um, over here we will have same thing, 100% deferred tax. Once again, there will most likely be group adjustments due to intercompany transactions or fair value adjustments, and under trade and other payables. So generally, trade receivables, trade payables, and long-term loans is hardly anything. There will be maybe in a case where you have an intercompany loan or you have intercompany management fees and it haven't been paid yet. Then you will make those adjustments. But just be aware that it's not always going to be the case. The more trickier ones is sitting in PPE, sitting in inventory, sitting in goodwill and investment in associates. Okay, so just be aware of that. That is basically how the statement of financial position would look like. Do we have any questions at this point in time?
No questions for me.
Okay. Now we will do the statement of changes in equity. So remember, every statement is for the year ended. It is only the balance sheet that is as at. So here we're going to say statement of changes in equity. Okay. For the year ended, whatever the year ended. So the purpose of the statement of changes in equity is to show users of financial statements a reconciliation between the opening balance of equity and the closing balance of equity. Basically, you are explaining to the users how an equity balance went from the opening balance to the closing balance. If you look at the balance sheet, we will have current year and prior year. So current year, you will have some numbers. Prior year, you will have some numbers. So the statement of changes in equity is showing users how share capital went from opening to closing, how retained earnings went from opening to closing. It's basically an explanation. In accounting, when you want to explain numbers, you use a reconciliation. Okay? So we're going to reconcile using the statement of changes in equity. So we'll basically have details. The, um, the columns will be everything that is on the balance sheet. Okay, so whatever you have on the balance sheet, that is the columns that you will have in the statement of changes in equity. Or whatever columns you have in the statement of changes in equity will be the columns in the statement in the balance sheet. So just be aware of that. The columns is every balance that will appear on the statement of changes, statement of financial position. Okay. Okay. So that is basically how it will look. Then we will start off. We're reconciling opening balance to the closing balance. So what we're trying to do is explain to users of financial statements how did the opening balance go from the opening balance to the closing balance. Okay, so generally, typical ones would be as follows. Okay, we would have a heading here, transactions with owners. So transaction with owners, I think it's something like that, called that they have it in the statement. Okay. So under transaction with owners, we can have, and so remember once again, I'm just preparing this for a group accounting situation that does not include changes in ownership. We will revise this and add to it when we come to change in ownerships towards the end of the year. So here we have acquisition of subsidiary. Okay, acquisition of subsidiary. Okay, acquisition of subsidiary. So you will have that line item if you acquire a subsidiary in the current year. You will only have this line item if you acquire a subsidiary in the current year. And then another transaction with the owner would be dividends. Remember, I think it was yesterday when we discussed the accounting equation. You have assets, liabilities, equity. Equity is split into two parts, transactions with owners and then business transactions. And the transaction with owners, it is dividends and share capital. Okay, remember, acquisition of a subsidiary is a transactions with shares and so forth. So therefore, it will fall over there. And then we also have dividends when you pay out a dividend. Okay, so that's very important. Then the typical examples over here would be we will have total comprehensive income. A total comprehensive income is required to be split between the two parts. What makes up total comprehensive income? Profit or loss and other comprehensive income. Remember, I'm using shorthand. You can't use shorthand. These are typical things. Another one, perhaps from a CTA point of view, that will most likely be is any transfers. Okay, So any transfers. So just be aware of that. So now let's handle. Remember, you'll have an opening balance, which will be that, which will result in the closing balance. For our purposes, there won't be any changes in share capital. In the real world, there is. For our purposes, there won't be. So the opening balance of share capital will equal the closing balance. And as a result, nothing will happen in this column. Okay. The big ticket line items is retained earnings, NCI, and now and then mark-to-market reserve are the big ticket items, NCI and retained earnings. Okay. So for profit or loss will appear under retained earnings. Okay, so remember the profit or loss that appears under retained earnings is the parent's portion of the profit or loss. Similarly, over here, OCI will be under revaluation surplus under mark-to-market reserve. Okay, once again, it is the revaluation surplus relating to the parent's portion. It's the mark-to-market reserve relating to the parent's portion. Then under NCI, under profit or loss will be the NCI's profit or loss, and the OCI will be the NCI's OCI. Now keep in mind when you do the split, if you go back to the income statement, the split is, where's the split now? The split is profit and total comprehensive income. So when you move to the income statement, you must be careful over here. You can't just go take the total comprehensive income number. This must be the difference between total comprehensive income and profit or loss. So please be aware of that. So take note, profit or loss for NCI goes in the profit or loss line item. OCI for NCI goes in the OCI line item. For the parent, this whole section over here is the parent. So profit or loss goes under retained earnings. OCI must be split into its relevant column. So revaluation surplus, mark-to-market reserve. Under the parent, remember under this section, it must only be the parent's portion. Under this section, it must only be the NCI's portion. Now let's go to the acquisition of a subsidiary. For acquisition of a subsidiary, the only line item that affects acquisition of a subsidiary is NCI. Okay, so under NCI, if you acquire a subsidiary in the current year, you will have a line item acquisition of subsidiary. And the only line item, the only column that the acquisition of subsidiary will impact is the NCI column. What's important to note that, so I'm going to highlight it in whichever color, green. Okay, so this over here. So what you should know is that what you must know that this number is basically, so this number is calculated. This number is calculated based on the NCI at acquisition. So in your at acquisition calculation, whatever the NCI number is goes over here. So remember, if you acquire a subsidiary in the current year, then you will have a line item at acquisition. At acquisition will impact NCI only. What is the number of the NCI? It is NCI, whatever you calculate NCI to be at acquisition. Okay, so very, very important. For dividends, dividends will be under retained income. Okay, so it'll be negative retained income. The dividends that comes under the parent's portion is only the dividends that the parent declared. So the dividends that is sitting under retained earnings represents the dividends that the parent declared, only the dividends that the parent declared. The dividends sitting under NCI, the dividends sitting under NCI is the dividends that the subsidiary declared, but only the NCI's portion. So I'm going to say that again. The dividends that is sitting under NCI is the dividends of the subsidiary, but only the NCI's portion. The dividends under retained earnings is only the dividends that the parent declared, whereas the dividends under NCI is the dividends that the subsidiary declared, but only the NCI's portion. So that's important to note. That's about it over here, but I want to explain to you how we get um, the opening balance of retained. Okay, now so I'll explain this in another, how we get the opening balance of retained earnings, how we get the opening balance of NCI. The same concept. If you can calculate the opening balance of retained earnings, you will be able to calculate the opening balance of revaluation surplus of mark-to-market reserve. Um, so I'll show you, not in this lesson, but I'll show you how to calculate the opening balance of retained earnings, how to calculate opening balance of NCI. Okay, maybe we can just one time do it. So let's do it over here. So the opening balance of NCI is as follows. Okay, so this number is calculated as the sum of. So the sum of NCI at NCI at acquisition. Okay, NCI acquisition of previous years plus since acquisition um, total comprehensive income. Okay, so keep in mind the way you get NCI is basically NCI at acquisition, excluding NCI of the current year, plus any since acquisition retained earnings and revaluation surpluses and so forth. Okay, so very important. I'm going to leave it at that. We will, when we do an actual question, then you'll see how it comes together. Similarly, over here, for all of these numbers, I'm going to explain it in terms of retained earnings, but you'll follow the same concept for revaluation surplus and mark-to-market reserve. So I'm only going to explain it in terms of retained earnings. Okay, so this number is calculated. This number is calculated as the sum of. Okay, so this is the sum of since acquisition, since acquisition retained earnings of the subsidiary and of the subsidiary and associate. Okay, but more importantly, it is so the opening retained earnings is the sum of the parent's portion. That's important. Sum of the parent's portion okay. So the opening retained earnings is made up of the sum of the parent's portion of since acquisition retained earnings of the subsidiary and the associate plus the parents plus the parents plus the parents opening retained earnings. Okay, so just be aware of that. Once again, as I just giving you a high level overview. When we do an actual question, you will see how it comes to life. And the whole point I want to get you to that when you lay in bed before you go sleep or something, you must be able to think through what makes up the statement of changes in equity, which numbers will make it up. You don't have to have actual numbers, but you must be able to explain the numbers in words like this. When we do an actual question, I'll give you like a format as how to calculate it, and then you will see it will come to life over there. But for all of these statements, you want to get to a point where you sit back and you want to be able to tell yourself how to prepare a statement of change in equity, how to prepare a statement of profit or loss and other comprehensive income, how to prepare a statement of financial position, without necessarily having numbers, and be able to tell yourself 100% of parent, 100% of subsidiary plus group adjustments, and then list the typical group adjustments. And for the SPLOCKY, for the SFP, as well as for the SOCKY, and then you want to be able to remember retained earnings opening balance and NCI opening balance. That carries probably the most marks. The next amount of marks, so the for the statement of change in equity, the numbers that carry the most marks is opening balances for NCI, retained earnings, and then this over here, your profit and loss line item. Those two numbers in the statement of change in equity carry the most number of marks. So you want to make sure you're able to get those numbers correct. So make sure you know what makes up an opening balance. Now, I know we went through it here. I don't expect to get it right now, but as we do more questions, I'm gonna continuously remind you of what makes up the numbers, so you can know it from a words perspective, other than just from a numbers perspective. I'm gonna stop there for tonight. Do you have any questions?
No questions from my side.
Okay. If you have no questions, then you can leave. Ashita, any questions? Naratu?
No questions.
Hey, Ashita. Okay. So once we start doing questions, you'll see how this come to life. What just happened over there? Let me just quickly. So once we start doing questions, you will see how this comes to life. And for all of these numbers, for that, there's a format because you're calculating goodwill. In the goodwill calculation, you need NCI at acquisition, so you'll get that. I'll show you a format for this, a simple table, and same thing over here. It's format for this. Basically, I'll give you a format, a table, based on what I just explained over here. Then you will see how, from a table point of view, will come together, and you can use that as a format whenever you have to do a calculation. But other than that, I'll see you guys next week. Don't forget to cover some of your questions um, for this week's for for week 2 of fact 2 fact 4. We have quite a few activities, so I'm busy uploading the activities. There's going to be 6 activities. 5 is activities, 1 is an assignment. So the 5 activities is going to be 2 to 3 questions, and if I select 2 questions, I'm still deciding, but it will be 2 to 3 questions. Let's say I select 3 questions. One of the 3 questions we will do in the class, and I'll tell you which one. And then the other 2 activities will be for you to provide me with some kind of a summary or something of that nature. The assignment, which is going to be slightly different, perhaps for some of you out of your comfort zone. Remember, going out of your comfort zone is part of growth. So CTA will add to your growth because it's quite complex, but we're going to take you beyond CTA, and there's going to be some stuff for some of you. Like if that was me, it will be beyond my comfort zone. Um, and that is that you're going to have to record a video, or you're going to have to record an audio. So I know some people don't like video, like I'll be one of those. So that's why I gave the option of an audio as well. So one of the two, and you're going to explain to me your understanding of group accounting. I've listed the stuff you need to answer, and you're going to explain. And that's going to be one of the assignments. So there's 6 activities that's going to be for you to do. Remember, you don't have to do all of them. I don't expect you to do all of them, but you need to at least do half. And the assignment is one of them. Okay. So I'll stop there. Have a good evening, and I'll see you guys next week. Don't forget, you can always ask me questions if you have, and I'll assist you um, as soon as I can. Okay. Okay, guys. See you.
Thanks. Bye.